Hey, this is Greg. Welcome to the channel. So with the recent enormous sell-off in Alphabet stock, along with the upcoming 20-for-1 stock split, this could be the biggest opportunity I've seen in over 10 years. Okay, so on this channel, we look for investment opportunities in addition to talking about the market, economics, etc. And this came on my radar screen very recently, and I want to talk to you about it right now. So Alphabet, along with many of the other tech stocks, has undergone an extreme sell-off. In this chart, you can see, this is the one-year chart, you can see the extreme sell-off that it's had in the last couple months. And of course, it's not been alone, but it really has taken a beating. And at the end of today's trading, it was trading for $2,330 a share, which on a historical basis in terms of valuation is extremely cheap. So in addition to the fact that I think we're basically in a bear market and virtually everything is getting slaughtered except for energy, which I would encourage you to check out all of my energy recommendations, and we've been long energy on this channel, but aside from that, everything has been getting slaughtered, and I think we'll continue to see, rough seas in the market for the foreseeable future. But one of the things that I think spooked the market with respect to Alphabet, which I think was unjustified and unfair, was their recent quarterly earnings report. So in the first quarter of fiscal 2022, Alphabet generated a little over $68 billion in revenue. They earned, $55.3 billion. So the top line grew 23% year over year. Okay, that wasn't bad, but then operating income increased only 22.2% year over year, from $16.4 billion to $20 billion, roughly, which, doesn't sound that bad, but it's really the rate of growth that was the concern to market. And finally, diluted earnings per share declined from $26.29 to $24.62, and that was a decline of 6.3% year over year. Okay, so it seems like what investors are concerned about is that in this quarter, it looks like the growth in earnings is beginning to slow down. And if you look at the last few quarters, it looks like revenue growth was slowing down quite dramatically, from 62% 4 quarters ago to only 23% right now. The reason I'm not concerned about this is I see this as just an adjustment from the COVID period where people were locked down and the ad revenues were surging on Google. Everyone was on the internet more than they are now, and I think the earnings and the business is just readjusting to the mean that we've seen over the past 10 years. Here you can see the breakdown of the quarterly results. Google advertising basically clocked in $54.6 billion. Other Google, 6.8. Total was 61.4. The Google Cloud is still showing decent growth, and I think that's definitely a growth area for the future. These other bets are all the other things that they're into, and there's some hedging gains and losses. So overall, revenues were $68 billion in the quarter. Now for the rest of this video, I'm just going to call it Google, because that's what I'm used to calling it. They reorganized their business a while back and changed the name to Alphabet, but I'm just going to call it Google, if that's all right with you. Google is an amazing business. It is a dominant business in its field, which is primarily online advertising or digital advertising. They control over 90% of the search market, which is absolutely incredible. And what I didn't realize until I did this video was they actually control 71% of the cell phone market through its Android operating system. Now that surprised me because I guess naively thought that Apple was the dominant player, but apparently Apple only controls about 30% of the market. Very surprising. Here you can see how the businesses break down. You know, search and other is about 58% of their revenue. YouTube ads, which is what we're on right now, is 11%. Google networking is 12%. Google other is 12%. And Google Cloud is now only 70%, but it's growing quickly. And then the other bets are less than 1%. In addition to the incredible earnings power of this company, one of the things I find very interesting about the business in general is the overall growth in digital ad spending, which has grown for many, many years and I believe will continue to grow. This chart shows the digital ad spending worldwide, and you can see that there is steady growth. The blue line is actually the percent of total media ad spending of all of digital ad spending. The red line is basically the change each year, and you can see it's an upward sloping line, and there is extremely good growth fundamentally underpinning Google's strongest business. Now, businesses like this interest me tremendously. Businesses that have moats around them, businesses that have dominant market share, and businesses that are extremely profitable. And Google and Alphabet have all of those three characteristics. But what I want to focus on this video, which is really my thesis for why we should go into the stock here, is really valuation. Okay, so the two things I look at the most when it comes to valuation are price to earnings and multiple of cash flow. Both of those statistics, if you look at this chart, both of those statistics are at historic lows. You can see that the PE ratio currently is 21.41, and the multiple of cash flow right now is 24.3 times. So the company right now is trading at a historical discount to the multiples that it normally trades at, which is something that I really like to see. Okay, so what we have here is we have a dominant business. Everybody uses Google. It's insanely profitable. It has been showing consistent profit growth of about 23% on average forever. So it's a growing business, and the percentage of that total media spend is expected to increase. So I like the fundamentals of the business, and I've been looking for many years for an entry point to actually get into this business, and I think the answer is right now, and it centers around not only valuation, but this 20-for-1 stock split. So let's talk about for a second what a stock split is, okay? When a company splits its stock, it is not creating any value by doing that, okay? All it is doing, it is taking a very high share price, in this case, $2,330 a share, which is very high, and it's splitting it into, for every one share at that high price, you get 20 new shares, and obviously because of that adjustment, the price goes down. So in this case, if you do the math, you have the current share price of $2,330. You issue 20 shares for each one of those 1 shares, and after the split, each share is going to be trading at $116.50 a share. Okay, now what does this do? What this does is it opens up the ownership of these shares to a lot more people. Okay, retail investors can more easily buy a meaningful number of shares, institutions too, and it just adds liquidity to the stock, which tends over time to make the stock go up in value. Now this stock split is going to be hitting in July 2022. What I recommend on this video right now is that you take a look at it, and you can play around with daily movements and stuff like that, but you're never going to guess the bottom. Right now, I think this is a good valuation to jump in at. The price might go lower, it might go higher. I don't know what it's going to do in the short term, but what I'm recommending is you buy as much as you can of this stock before the stock split, right? And even if it's one share, okay, you end up with 20 shares after the split. And I think that primarily because of valuation, but also the added fuel to the fire and the added like juice in this deal is that you're going to get that stock split in July. And I think if you do this, what I'm recommending, which I am going to do, I'm going to do it within the next couple of weeks. I'm just reallocating capital around, and I'm going to buy as much as I possibly can. I think you're going to be very, very happy that you did. All right, well, I hope you got value out of this video. And if you did, please like and subscribe and hit the bell so you can be notified of future videos that'll be coming your way very soon.